Hi, I'm attorney Kelly Longtin from Kelly Longtin Law, where we focus exclusively on estate planning for everyday families. Now, today I want to talk to you about how a community property trust could save you money in taxes. Now, when it comes to your family's legacy, every dollar you can save makes a difference. One way to keep your accounts and your property out of the hands of the IRS is to form a community property trust. So let's talk about how a community trust works. Community trust can save you money on taxes by adjusting or stepping up the basis of the entire property after the first spouse's death. Now, basis is generally the cost or the value of an account or property at the time it was originally acquired by the owner. When you or your spouse invest in property jointly, be it real estate or stocks or other assets, it becomes community property if you live in one of the following 9 states: Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, or Wisconsin. However, there's also 5 states, Alaska, Florida, Kentucky, South Dakota, and Tennessee, where community property treatment can be utilized through the creation of a community property trust, even if you do not live in one of those states or a community property state. Now, when married couples work with their estate planning attorneys to create these types of trust, they can take advantage of a full step up on the property's basis. At the death of the first spouse, the basis of the property is stepped up to the date of death value of the account or the property. This is different from jointly owned property, which only receives the step up on one half of the property, the half belonging to the deceased joint owner. Now, a full step up in basis means the capital gains taxes are much lower if the surviving spouse wants to sell, because the value of the entire account or property has been adjusted. Now, community property helps couples reduce their income tax liabilities after the first spouse's death if an account or a property is sold. Now, you want to get to know the community property trust terminology. So you first want to start with a few quick definitions of the financial terms that you'll need to know to get a sense of whether a community property trust is right for you. So let's begin with community property. Accounts or property that a married couple acquires by a joint effort during their marriage if they live in one of those 9 community property states, again, Arizona or California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, or Wisconsin. So the next term that you want to familiarize yourself with is the community property trust. Now, this is just a particular type of joint revocable trust designed for couples who have highly appreciated accounts or property, enabling them to take advantage of a full step up in basis. Even if they do not live in a community property state, they can be formed in Alaska, Florida, Kentucky, South Dakota, as well as Tennessee. Now, you want to understand what the term basis means. Now, basis is what you paid for an account or property, or the value that is used to determine gain or loss for income tax purposes. A higher basis means less capital gains tax. The next is you want to know what stepped up basis means. Now, accounts and property are given a new basis when transferred by inheritance through a will or a trust, and are revalued as of the date of the owner's death. The new basis is called a stepped up basis if the value has increased since the account or property was acquired, or stepped down basis if the value has decreased since the account or property was acquired. A stepped up basis can save a considerable amount of capital gains tax when an account or property is later sold by the owner. Now, a full step up. Because of a tax benefit, the community property receives a basis adjustment on the entire property when a spouse dies. So if a surviving spouse sells community property after their spouse's death, the capital gain is based on the increase in value from the first spouse's death, where that basis got adjusted on both spouses' share, to the value at the date of the sale, allowing the survivor to save money on capital gains tax liability. Now, one of the best parts of estate planning is getting more than what you out of it than what you put in. In just a short amount of time, an estate planning attorney can implement a community property trust that could save your spouse and family tens of thousands of dollars in taxes in the future. You'll want to call an estate planning attorney that is licensed in the community property state in which you live in order to implement this. So I want to thank you for watching. I'm Attorney Kelly Longtin from Kelly Longtin Law, where we provide effective estate planning for everyday families located in Massachusetts and New Hampshire.